Last week, as I was editing our episode, I very quickly noticed that my intro story went over 5 minutes, and the total intro was over 7 minutes long. It's something that I struggle with, so in the interest of brevity this week, I am only going to tell a very short intro story. When I was a kid, I was fascinated with tax forms. And we would go to the post office and get the tax forms. For those of you who don't remember the Stone Ages, when we didn't have all of our tax forms online and we couldn't file online, you had to go down to the post office to get your tax forms. Mm-hmm. And they were all free. And so as a 9, 10, 11-year-old kid, I would grab a bunch of tax forms and take them home, and my dad would do his taxes, and I would sit and do fake tax returns on the side. So someone might have seen that and realized that my future was in financial services. So with that, we will start Episode 13, lucky episode 13 on taxes, the silent partner. Welcome to the Valuability Podcast. The Valuability Podcast is for financial advisors, business owners, and anyone interested in financial planning, business, leadership, and personal development. We believe that financial success comes from building a plan on the foundation of your values, and building your ability will help you get there. My name is Danforth Fleek. I was a financial advisor and product wholesaler for over 20 years, and I'm joined each week by my co-host, longtime friend and mentor, Philip Simonson. Philip was also a financial advisor, a field leader, vice president with various roles for financial services companies, in international financial services companies here and in the United Kingdom. Philip, quite a week here in Minnesota. Probably not any disturbances up in the Cook, Minnesota area, though.
No, Dan, we were up here where the men are strong, but women are stronger. It was pretty quiet. Although just, Virginia, Minnesota, our Queen City, they did, targets across the country, country were closed. So, I just continue to hope and pray for humanity to rise above this, and healing begins.
Absolutely. And for those of you who have listened to the podcast in the past, you will know that I am actually located in Minneapolis. My part of town was very quiet. I'm about a little less than a mile from where some of the damage occurred. But I'm happy to report that over the last 2 days, we've seen the true spirit of Minneapolis shine through, and things have been quiet and peaceful. So, and with that, we will move on with the rest of the podcast. You can find us anywhere you find your podcasts: Apple Podcasts, Spotify, Stitcher, TuneIn, or you can find us on our YouTube channel. Search Value-Ability on YouTube. You can also find us on our website, value-ability.com. Click on the Episodes tab. Wherever you find us, as always, the mantra of podcasters everywhere: like, review, subscribe, and share. And then, of course, at this point in our podcast, sharing is the biggest thing you can do for us. Please sign up for our mailing list, value-ability.com. Under the Contact Us tab, we have specific extra content for people on the mailing list. So if you're interested in our content, we give away free content on our website. But if you would like extra content, sign up on our mailing list to get that, as well as updates from us. Follow us on Twitter and Instagram at value_ability. Twitter is the best way to get in touch with us if you have a topic or question. Instagram is where we post visuals. If you're not able to get to our website, where we also house all of our visuals, if we talk about a document, we will also put it up on Instagram so you can see it while you're out and about on your phone. And you can also get in touch with us through our Facebook page. Search at Valuability, all one word, on Facebook. Just one quick note, we are going to be making a format change. In the past, we have done or tried to do both an article and questions, and we have decided that we're going to do either an article or questions each week, so whichever is the more interesting on that side. So with that, we will start off on our main topic, taxes. Now, Philip, you wanted to start off with a little history of taxation in our country and get the conversation started there, right?
Yeah, I would, Dan. Just to lay down some of the basics, the 101, so we have a foundation to work from.
Great.
And the history of the taxes in the U.S. really occurred 1913. And then there was the 16th Amendment. It allowed our federal government to start taxing our income. And how it was set up, it was kind of the old Robin Hood, rob from the rich and give to the poor type of marketing strategy. They had to get the vote to get people to say, yes, I'm aboard with this taxation of income. Well, the middle class and low income, they weren't too excited about it, but as long as they said, the rich were going to be taxed, they were okay. So they did. They started the tax, and what you can know about and what happened is, governments, how they generally work, and I'm simplifying it, but they don't get you don't get rewarded to save money. They get rewarded to spend money and grow their organization or their business unit or agency. And they want to do that because if they don't, there might not be money there next year in the budget for them. Now, corporations, on the other hand, or capitalists, they want to make sure they keep it. Their motive is to keep it so they can reinvest it and have the money earn money and grow even faster and create efficiencies and effectiveness. Well, initially it was all working out well. And the government was able to hire people, and they had their salaries and they had their pensions. You got to remember now we're back in the industrial era, so the government, to help the rich, they gave big fat contracts to a lot of these manufacturing companies and the fat cats. So that was all good. But again, scope creep, etc. They kept the government growing the government to the point where then they needed more money. So eventually the middle income and the poor became taxed. So what did the rich do then? In the rich, in this case, they set up corporations. And the reason why they set up corporations, and history was already had known about corporations. It really started back in the sailing days when the ships would come over from the UK, the motherland, to the U.S. Well, they wanted to reduce their risk in case they hit a hurricane or something happened. They'd limit their liability and their financial liability, and so the rich said, well, you know what, we can set up corporations. And the corporation's fairly easy to set up. Dan's going to talk a little bit more about that, but in here in a bit. But the whole thing about a corporation is that corporations earn revenue, and from there, then they spend. So they can spend, and then they pay tax. Things that they can spend before are taxed, they can do a lot of write-offs from their equipment to their, be it computers, to be it cars, or they can take mileage deductions. They can pay for meals. They can pay for the internet today, the telephone. I'm going to have my annual board meeting over in Hawaii. And, then they pay the tax. But the individual, the middle class, and the poor, they earn a salary. From the salary, then they have to pay tax. That's that silent partner that we talked about, and that's the person who shows up to work every day but doesn't do a lick of business. I call it the IRS. And then they spend. So if you think about now, and stay with me on this, I'm going to give a quick illustration on this. So if you're federal tax brackets, it's called marginal tax bracket, progressive tax bracket. So the more you make, the more you got to pay. And I always looked at taxes, I must be doing something right. That's okay, but I never want to pay in more than I have to. So if you're now in the marginal tax bracket, let's say you're filing, you're filing married. You went down to that post office. Now today you go online, but you're filing married or jointly. Married filing jointly. If you get to 80,251 to 171,050, now in the first bit of the first 80,000, that's going to be taxed around 12%. But from 80,000 to 171,000, that 90,000, that's taxed at 22%. So you're only keeping 78 cents on a dollar. Then they've set up the Social Security. That wasn't set up till, we'll do a whole topic on that. Dan's a master of that. He's done thousands of seminars on that. But 6.2% is withheld from an individual's paycheck. So then Medicare, they've got to put in for, that's 1.45%. So you're up to, 7.65% plus the 22%. You're almost at, close to 30% there. But then you got, then let's not forget, not just the federal, but there's only 8 states that do not pay a state tax. Minnesota here, you could be paying as high as 7% on average here. Well, you're up to approximately 35% now in taxes. And I'm not even counting real estate taxes yet, or, your license tabs, etc. So if you have 12 months out of the year, and if you're at 35%, there's 4.2 months that you're working for the IRS or your silent partner. A lot of people then in the rich said, whoa, why, you're going to keep charging me that much. There's no need to go to work. So they set up again these corporations. And now let me just do an asterisk. If any of you, if you know your accounting, etc., that's not the overall, that marginal tax bracket, 35%. It actually, the effective tax bracket, being what your overall percentage being taxed would be lower, because I did skip that first 12%. But it's going to still be 30 to 35%. It'll fall in there. So you're still working the first 3 to 4 months for free. So going back then, what they did and what the rich did is they set up these corporations. And think about these. Well, let me just stop here. I want to tell a little story here. If any, my dad, first generation, he never made more than $35,000 a year. I think he worked, never finished. He was born in 1918, so he grew up in the dirty 30s. He didn't finish high school. He had to go off to CC camps to, $30 a month, and then they'd send home 25. He was allowed to keep 5, and from there he went into the war. Upon coming back from the war, he went to work for Ma Bell. Ma Bell would be the equivalent of Microsoft today, and he started climbing telephone poles and did get into management. But again, raised 4 children, put a roof over our house, and he eventually became a millionaire. It was probably in his 70s, but how did he do it? He took $25 each month, and there's time, then there's dollars invested in either domestic or foreign enterprises. And so it's time plus money plus owning equities. You do amass some pretty good wealth here. The millionaire's mind, or the millionaire next door. Let's just share some things on what we learned, there's two great books to read. But the average American, there's 3 to 4% become millionaires, and 82% of them are first generation. So it still works in this country. The system still works. And and of that 3 to 4%, they're probably around age 53 to 56 before they reach that level. But most of them, they're not doctors, they're not corporate executives. They are generally self-employed people. The number one occupation was millionaires was auctioneers. They understand the value of a dollar. They live well below their means, and they value financial independence over social status. So they don't, their cars are usually 6+ years old. They don't pay more than $100 for a watch. They buy their suits, and the old Jacques Penet, no more than $200 for their suit. They don't have, the cars are generally American. The most they ever pay is $29,000 for a car. Very few pay more than $54,000. They live in a home of $250,000. So they learn to live frugally and pay themselves first, and they set it up. They set up corporations. They make on average around a little over $200,000, but they pay taxes on around $150,000, and they save close to 20% of what they make. They invest it, shall I say?
Now there's even more now, of an reason to go the corporate route, right? This last set of tax reforms, tax changes in 2019, now effective in 2020, used to be that you could be a sole proprietor and not have a corporate entity, and you could still deduct a fair amount of your business expense. And my understanding now is that you really have to go the route of having a corporate entity in order to take full advantage of that kind of business deduction, right?
That is, again, yes. And that is my understanding. And you bring up a great point. Now, in financial intelligence, and that's what, one part of our podcast is that, give our knowledge and impart it so that you can become more confident in investing or helping your clients as well. But financial intelligence comes down to, one, you got to know the basics on accounting. The balance sheet that I just mentioned, or reading the income statement. Remember, so the accounting, you want to get, you have the basics of accounting down. Then investment strategies, knowing how to invest your money. If it's using asset allocation that won the Nobel Prize in economics and back in '91, or is it? Then you need to know also about marketing, the old classic, economics 101, marketing is supply and demand. Then there is the other tax laws. Now I do not have mastery of it. So, but it's Henry Ford. They tried to, he went to trial. They said he wasn't a very bright man, and his defense was, well, look, yeah, you're right. I might not be that bright, but I'm bright enough to know this. I went and hired the best attorneys here, and I got the best tax lawyers. So that isn't very bright. I don't know what is.
And I would tack on there, just from my own experience, when I, got out of the corporate rat race 3 years ago and decided that I was going to take my sabbatical, obviously my savings were the area that I was going to live on during that time. And I had done a pretty good job of saving in a tax diversified manner, and I'll talk a little bit more about tax diversification in a bit. But I had about equal chunks in my Roth IRA and my pre-tax IRA, which was a combination of IRAs and 401ks from over time. And without consulting my accountant, I just started using the Roth money because I thought, well, that's the tax where I can take my contributions out tax-free. That's going to make the most sense. And I ended up using almost all of my contributions. So now I don't have any contributions left to take out of the Roth. And I've now switched over to my deductible IRA. Well, come to find out, my accountant hasn't told me this, but I've looked at my taxes and it's actually been better for me from a tax standpoint to be using my pre-tax IRA because of the fact that I own a property and I have business. We're able to use some deductions to offset the 10% penalty, and so it's a lot less prohibitive than I had thought. But silly me, I didn't follow my own advice. I didn't go to actually, your accountant is my accountant, our accountant, and ask him which strategy should I use. I just kind of picked the one that investment guy thought, and there I didn't follow my own advice, which is don't get beyond your expertise. So I just wanted to throw that in there that, sometimes something that seems super obvious may not be quite as obvious if you're not an expert at it. And many financial advisors fall victim to that. We'll talk a little bit more about tax diversification in a minute, but I just thought that was a good point to put that story in.
No, that's great. And the key then, you're going back, and I want you to take away just on the history is corporations they set up. Now, a corporation, you're setting up an LLC, and Dan's going to talk a little bit more about it. It's a legal loophole. Also, the government will give, generally corporations are taxed at a smaller marginal tax bracket, and they want to make sure they give corporations incentive to invest. And by investing, what I mean by that, invest by building factories, invest by providing a service that's going to need, so that then they will hire people. Because I don't know the exact statistic, but I want to say small businesses that, that's 200 people or less, they end up high, of the employee workforce, they generally, I want to say it's over 70% of all, employees work for, a company of 200 people or less. So that's what makes this country great is that economic power. It is our small businesses and our middle class, because when we go into a recession, it's generally this one's going to be tough, harder, of course, but it's generally a V. History shows in and out in 18 months, versus when I was over in England, where they didn't, back in the early 90s, they did not have as strong as middle class. When you go into a recession, and then all of a sudden, they raise the interest rates are high, they choke off inflation, so they raise the interest rates. That puts us in a recession. Then they start lowering interest rates, so the small business owners will go out and borrow, and when they borrow, then they're going to be investing and creating jobs. And if you don't have that small business owner and middle class to go out and borrow money, your economy is not going to go in. The stimulus package, I hope people, I'm going to deviate, spend that money. That's what it's there for. Some people my age who are 62 or older getting their Social Security, there's no incentive to work. They're giving all this money to the people, and they're not doing anything to earn it. Well, you know what? Here's my viewpoint. I'm grateful that they've got it. If it's used for the way it's supposed to be, to spend, it's going to put money into the economy, and we need it, my generation, because, if we have people working, that 6 point I described earlier, and that 6.2% going to Social Security, that's what's keeping our checks coming in. I haven't collected mine yet, but for many. So, Dan, I would like to then talk, if you're good with this, there's 3 buckets in how you can invest your money and talk to someone about that tax diversification and the strategies with these 3 buckets and how they all work in regard to programs that the government has set up for individuals here to invest.
Perfect.
You good? All right. So the first bucket then, and the first bucket here is that pre-tax and tax deferred. Now, examples of this, probably the most common one for everyone is the 401k and the traditional IRA. Tax sheltered annuities, nurses, teachers, charitable nonprofits are eligible for those TSAs. Then there's the thrift savings plans. That is for federal employees. Then you have small businesses, could also set up, SEP plans, simplified employee pension plans, etc. So the key thing here, these are generally called qualified plans. It's pre-tax. So you can earn the first 100,000 if you let's say you make 100,000, excuse me. And you make 100,000 and you invest 10,000 of it into a 401k. Well, you're only going to be taxed now, just like a corporation here. This is where we're giving you a break. You're going to you're only going to be taxed on 90,000. That 10,000 is going to avoid the IRS making that one-way trip. And if you're in that marginal tax bracket, married, filing jointly, that's 22%. So you have saved. Now, if you invest 10,000, you've saved $2,200. And now all of that grows tax deferred. Now, oftentimes I hear people say, well, this, tax deferred, you may be saying to yourself, if I'm going to have to pay tax someday, why don't I just don't go ahead and pay for it now? Well, my answer to that is that by paying $1 of tax now, you not only lose that dollar, but what that dollar would earn if you were allowed to keep it. Because if you end up working for an employer, it's going to be hard to get ahead. You can, but it's going to be hard. And because you're really now working for money. And for most people, now I'm generalizing, but a lot of people just work just enough so that they don't get fired. And employers, on the same hand, they just pay enough so the employee doesn't leave. But what you really want to do here, if you want to ultimately achieve financial independence, you want to have your money earn money. So you're working for your money to earn money, and you're putting it in the asset column and on the balance sheet, so it's earning you money.
Yeah, just a quick point there. I hear people say that quite a bit, right? Making that point about, well, why don't I just pay the taxes now? Because if I put the money away, then I'm going to have to pay more in taxes later. People focus too much on the tax amount and not enough on the end goal, right? Goal-based financial planning, right? The goal is to get you to your goal as quickly as possible. Look, I've looked at it the same way. Like every time I've had to pay in a big chunk in taxes, it's because I had made a big chunk. And so I always looked at it from a glass half full standpoint of saying, wow, look, I've done this well, so now they're gonna tax me for it, right? So focusing on the amount that you pay in taxes isn't the right way to look at it. What you want to look at is, do you have the biggest amount left over at the end? And that's what using tax deferred accounts allows you to do. It allows you to grow, keep that money in the pot so that it grows. And as we've talked about in the past, time value of money, compounding interest, the power of that over time makes the pot bigger. Yes, you end up paying more in taxes, but it allows you to control how you pay taxes in the future. And the goal then is to hopefully pay at a lower tax rate when you take the money out in retirement, and that will leave you with more money in the end.
And let me, Dan, I just worked it out, with that example, and let me build on just what you just said. So if you take that 10,000, you put it in to your 401k, and let's just do it for 10 years. Well, that's, and if you're putting it in monthly and you're getting a 10% rate of return, that's $833 a month. Well, at 10 years, it'll grow to $170,635. But if you want to, invest that same $10,000 after tax, well, you're only able to invest the $7,800 because $2,200 100 made that one-way trip to the IRS, your silent partner, who shows up to work but doesn't do a lick of business, or doesn't do a lick of work. Excuse me. Well, at 10 years, at 10%, that's $650 a month. That'll grow to $133,000. So 170 to 133, and if you go 20 years, it's $632,554 versus $493,589. So it's about $150,000 more.
Just over 10 years.
Yeah, well, that one's at 20.
Oh, 20 years, okay.
So take that $150,000 more, having your money earn money. If that got you 10%, that's $15,000. That's over $1,000 a month.
Yep.
So you want to build that asset column, and the other thing, if you go back and listen to our podcast with the silent embezzler, that's the cost of goods going up. That's inflation. Another reason why I like tax deferral is every year that you postpone paying tax, you not only continue to receive earnings on that money, but when the tax is due, if we continue to have inflation, you can pay it with cheaper dollars, down the road, 30, 40 years, for which you've had to work, fewer hours on. So if you had a $1 of taxable income today in a 22% tax bracket, you lose 22 cents, remember. And then if you're purchasing or earning power, if you had to pay that tax. But if you can postpone that tax for 24 years or even longer, but just, the rule of 72 that we've covered with you, 24 years into 72, that's, if you had a 3% inflation divided into 72 in 24 years, I'm paying, the tax with the money that's worth half of what it was worth back 24 years ago. So another good reason to defer, and I like what you said, Dan. It's based, it all ties to when you finally get financial independence, and we define that when work is optional and retirement's affordable. So that's pre-tax dollars, that's bucket one, and tax deferral. So then the next bucket, that is after-tax dollars, and it is and then you also, it's taxable. So examples of this sort of money, this is CDs, money markets, checkings, savings accounts. It can also be equities. Now, the equities, if you hold it longer than a year, it's not going to be taxed as ordinary income. And this is all called unearned income. It's taxed at your top marginal tax bracket. Not in that first, marginal bracket. So if that's, the example I shared with you for the married filing jointly, if you're 80,000 to 170,000, all this is going to be 1099, and any dividend income, or if you bought you bought shares and sold it within a year, that's going to be treated as ordinary income versus capital gains. If you bought something at $10 a share, and it went to $20 a share, you got got appreciation of $10. When you sell it, it turns what they call a gain. You have to pay tax on that $10 of gain, from 10 to 20. Well, it's only going to be taxed at, depending on your tax bracket, 15%. So it can be lower than that 22%, in the example we just provided there. So this bucket of money, and real estate can be in here too. Real estate can slide in another area as well, but because of the depreciation that Dan was mentioning, and also something called I think it's 1031. As long as you keep, if you sell your place and you buy another place that's of equal or greater value, you don't have to pay any tax on that appreciation.
Yeah, that's a 1031 exchange. It would be the real estate exchange without taxation. Yep.
Yeah, very good. And that just, that bucket two, that's just your ordinary, that's taxable after tax dollars, and it's the earnings is taxable. That you tie that money, that's your liquidity needs. And so again, that's based upon goal-based planning. How much money you're going to need to put a down payment on a house, etc. You want to keep that money out, because that first bucket we talked about, there's penalties with that qualified money, 401k, TSAs. If you take it out before 59.5, usually you have to pay a 10% penalty, unless it's there for an emergency and other examples that Dan will cover. Then the last bucket. The last bucket is after tax, and then dollars. And then, when those dollars, after tax dollars, earn you money, so your money earning money, it's called tax exempt or tax free. Examples of that is your Roth IRA, municipal bonds. They're tax exempt or tax free. The interest you earn on those bonds, they're are state tax free and federal tax free. T-bills, T-bonds, that interest is federally taxed. It's tax-free. And then, of course, there's some complicated insurance strategies that you can use as well that can be tax-free. Example, and what I like also about tax deferral, it's called the stepped-up basis. So if you have if one of your values is to leave a legacy, and that's leaving something behind to either your favorite charity or church, or to your family. If I bought, let's say, I put for 40 years, I did $2,000 a year into my IRA. I got an overall 10% rate of return. Well, 2,000 times 40 is 80,000, and it grew to $1 million. Well, you can do, or even that can be stepped up where there's no tax. Same thing with your house. Anything that you own. It's called stepped up, as they get the people who are your beneficiaries inherited at the cost basis on the day in which they receive it.
Now, just to be clear there, it could be subject to estate taxes with certain limitations. We're talking about income taxes.
I'm glad you said that. Now, in federal, it's well over a decade, right. Million, 10 million. So, but Minnesota, it's I want to say it's now 3.2 million this year, but I'd have to go back. I'm not practicing every day with the clients,
right?
But yeah, that's again why you need to hire out a good tax accountant. A good one is well worth his or her money.
Yeah, the thing that I always like to add on this topic of the three tax buckets is that for many financial advisors and clients, people that do their own investing, they tend to look at tax planning in a pretty silly way. Most of the time, they'll look at it and say, okay, well, if I put money in, these different tax strategies based on today's tax code, and I leave it there for 30 years, and then I yank all of that money out, still based on today's tax code, what will be the best option? And then they think that that's a quote-unquote solution. And that whole entire thought process is, I worked for an insurance companies, annuity companies specifically, for years, and every single tax deferral piece that tried to promote non-qualified tax deferred annuities used this method. And every time I saw it, I was just like, this is silly. Like, every supposition you're making, every thing that you're looking at is false. The tax code doesn't stay the same for 30 years. The tax code is very volatile. People think of the tax code as this monolithic thing that doesn't change. Now, it doesn't change very often relative to, say, the stock market, but relative to a lot of other things, it changes quite often. It's changed drastically since 1996 when I got into the business. And
go back to 1913.
Right. Go back to the 1950s when the top tax bracket was 95%. I mean, taxes have changed drastically, and they do change drastically. And so this idea of taking today's tax code and making a bunch of decisions based on today's tax code, like, think about all of the time and effort that was put into estate tax planning for people, 20, 30 years ago, and now that limit's at $10 million. And, a lot of those people aren't going to qualify for the estate tax. Now, that isn't a great example because had it not changed, those people would have been very negatively affected by that. But I'm just using it as an example of the fact that things that you think might never happen can happen, right? And one great example of that is oftentimes I see recommendations from non-financial advisors when I'm looking at online forums and things like that. If you're young, put everything in a Roth. Put everything in the Roth. Put everything in the Roth. Well, there's one thing that would make putting all of your money into a Roth, even as a young person, not very smart at all, and that would be a flat tax. Right? Paying all your taxes today and then 25 years from now having a flat tax come into being and it's at 7%. That would be ridiculous. Now, the concept of a flat tax is, it's discussed quite a bit, but it's pretty far out there. There's a lot of forces against it. So it is possible that it might never happen. But I've said plenty of things were never going to happen that did end up happening. So that's just one example that I think is a really good example of something that many people will say, well, that will never happen. And I've made a career out of saying things will never happen, and then they happen almost immediately after I say that. So, but tax diversification is super important because of this. So how do we deal with a situation where we're trying to achieve something and we have a set of circumstances that are volatile and they pose risks to us? Bottom line is you diversify, right? And that's why when I ended up in the position I was when I took my sabbatical, I had pretty much equal parts deductible and Roth. Now, I kind of blew it, as I mentioned before, because I didn't then take my own advice and go to my tax professional to find out. I thought I was smart enough to do it on my own, but it put me in a very good position. I had the resources I needed in the places that I needed them. And, so many times people look at things and they say, well, I just can't imagine ever needing to have money in, that tax status. And then 10, 15, 20 years later, their life changes. And then they realize why they wanted it there. So that was just the last bit that I wanted to tack on there, is to say it's why tax diversification is so important, is that taxes change and some things will be grandfathered, but overall having monies in all three buckets is vitally important. And again, it goes back to the goals, right? What goals are you trying to achieve, and making sure that we are trying to achieve them as best we can, while still giving you flexibility for unforeseen circumstances and things that change in your life. So with that, are we ready to move on to the question?
Yeah, let me just wrap up.
Sure.
Thanks, Dan. Three main things I want our listeners to take away from this today. And the first is knowledge is power. And that's that financial intelligence I talked about before. Get brilliant at the basics, just around accounting, investment strategies, economics 101, supply and demand, or knowing knowing demographics, and tax laws, or make hire out, as we've said. If there's any of those areas you don't have energy around, well, then get an expert. They'll be well worth their money. And we talked before about how to interview for top 10 questions to interview and find a quality advisor on your team. Setting up, setting up a corporation, an LLC, it does not cost much. And as long as you make money at that, you got to be making money at it at some point. And I would look it up. I want to say, if you're 5 years, the first 3 years it might be lenient, but the fourth and fifth year you better start being able to show how you're making money. It can't be all losses, but do something you're passionate about, and go after it. But learn that you can create revenue, then spend, and then pay tax. Walk away with that and build your asset column. That's the last bit where your money is earning money. If you got $1 million earning 10%, if you're 25 listening, but 65, 62, I can tell you comes around pretty quick. 10%, you got $100,000. That's a great silent partner working for you. Now, I like that one versus the IRS.
Very good. Just good we did not move on to the question, and you made those points because I did have a few last things. Just to give you an example, it cost us about $700 to set up our LLC, and that was actually the expedited process. I think we paid, I want to say $250 more than we needed to because we wanted to get it done by the end of the year. So we filed in last December. So, $400 to $500 to file an LLC. I did it online. And there was someone there to walk me through it the entire way, and we got that done. And then the last point I wanted to make is just to follow up on the comment you made earlier about small businesses in the United States, and to say how unique that really is. I was born overseas. My dad was in the Navy. I was born in Greece. We lived overseas when I was young. I've traveled extensively overseas. And even with that, this last sabbatical time I took during the last 3 years, I was traveling and visiting a friend in Europe. And one of his friends has similar background to me, born overseas, lived all over the world, Africa, South America, Europe, a number of different places, but had never lived in the United States. Very sharp guy. We really hit it off. We were out to dinner, and he and I were talking and kind of going back and forth, and we were talking about lots of different things, politics, economics, and I said, the one thing that I've always said that America gets 100% right. There are plenty of things we don't get right, but there are lots of things we do get right. That is the ability for someone to start a small business. And he literally just said, "That's not true." And I was taken aback by that. I'm like, "What are you talking about?" He's like, "That's just a myth." And I'm like, "No, it's not." There's a pretty low barrier in the United States to starting a business. And I say that simply because that is not true other places in the world. And I think too many people take that for granted in this country, that there really is a low barrier to starting a business, and it's higher other places, and so much higher in other places that some people don't even believe. A highly educated and well-traveled person doesn't believe that there's a low barrier in the United States. So I just wanted to tell that story to wrap things up and say, take advantage of that. It's where our economy is going, is towards that self-employment and, independent contractor kind of environment. Take advantage of it, understand your taxes, as Philip said, and make the most of the opportunities that you have. So with that, we will move on to our questions for the week. Question number 1, this one is right up my alley. Philip has already seeded it to me, but it's something that I hear often about investing. And that question is, for people who plan to buy and hold stock index funds, does it make sense to buy a 2 times or 3 times leverage fund, given the expectation of markets rising over the long term? Now, this has been cleared up a little bit in recent, I'd say the last 6 to 12 months. I've seen some of the product companies who build these leveraged products doing advertising, pointing out the fact that absolutely this does not make sense. These are not long-term investments. They are not designed to be held for the long term. And the reason for this is that the leverage is handled on a daily basis. So they take the leverage position at the beginning of every day and they close the leveraged position at the end of every day. This is not a investment company that's buying and holding stocks. It is a company that is using derivative products to create leverage on a daily basis. So the bottom line is, because that leverage is unwound on a daily basis, the downside losses will count way more than the upside ever will, and you are locking in those losses on a daily basis. And so the net effect of holding a leveraged fund over time is that your account value will dwindle and dwindle and dwindle and dwindle and dwindle, and eventually you'll get to the point where the account, if you hold it long enough, the math works out that it is simply just going to erode your assets over time. So take a look. If you're interested in those leveraged funds, holding them for short term is perfectly reasonable, but you need to be a pretty advanced trader, somebody that needs that daily leverage for some reason, and it's not for your buy and hold investor to use those products. So moving on to the second question, what is the difference between a traditional and rollover IRA? Actually, when I first got this question, I had thought that the tax changes during George W. Bush's administration had completely done away with the need for a traditional versus a rollover IRA. So prior to that tax change, the difference was a rollover IRA were assets that had come from a qualified plan. So as Philip had mentioned, a 403B or a 401k or some kind of qualified plan. And you would move it into a rollover IRA under the expectation that you wanted to move it back into another qualified plan at some point. And if you commingled those funds with other IRA assets, prior to that tax change, you were not allowed to move it back into a qualified plan. The actual tax law prohibited you from moving it back. So you would have separate IRAs. You'd have your contributory IRA that would be labeled a traditional, and then you would have the rollover IRA. I was under the impression that that was all gone. Were you under that impression as well, Philip?
Yes.
Yeah. So in doing some research on this, just to make sure that I wasn't talking out of my rear end, some plans prohibit the commingling of funds. And so that is why the rollover IRA concept, I did always kind of wonder why I would still see accounts labeled as rollover IRAs. But like most things, the law doesn't prohibit it anymore, but the plan can prohibit it. So, and apparently it's enough plans that it can be problematic for people. So if you're considering moving money back into a qualified plan, consider using the rollover IRA and not commingling it with the rest of your traditional IRA assets. Now, most people, with the advent, back when I started even in the business, the access to good low cost carriers for your IRAs was pretty low, and so people wanted to use their 401ks most of the time because a lot of times they had better cost structures and things like that, and just simplify, keep things all in one place. Nowadays, people have gotten more used to the idea of having money outside, so that's how I always looked at it. I never wanted to roll money back into my 401k. I wanted to have control over it, and I had a good low-cost IRA carrier. So, but I thought it was interesting, actually, when I was looking up. That's why I added this question, was it was something that I had not realized was still around. I thought because the tax law got rid of it, that plans would have just followed suit. But apparently there are enough plans out there that still prohibit commingling of funds, that's why the rollover IRA status still exists. So any thoughts on either of those questions, Philip?
No, very good, Dan. I just was going to say a clarifying statement, or make a clarifying statement here, is that while you were talking as well, of course, I was multitasked, and I knew that the federal estate tax exemption is now, and they passed a law that it's indexed to the CPI. So I think we had said we knew it was well over 10 million. It is actually today 11.5 million, 11.58 million per individual, up from the 11.4 in 2019. So it's not going to impact probably a great deal of our listeners. The state one, know your state, though, that's important. But these are the government is allowing you to pass on some your money to your heirs, which is a good thing. And in future, we'll talk about trusts and actually get more strategic on different tax strategy techniques, or we'll have a special guest, an expert on tax strategies. So I think that's what we'll do down the road, Dan. And with that, over to you.
Very good. Yes, we hope that you have to deal with the federal estate tax.
If you do now, and that's a problem for you, we'd love to have you as a guest.
Absolutely. Well, that's what I always say. If they're trying to tax you, that you're doing something right. Right?
Correct.
Excellent. So with that, we will wrap up for the week. If you have topics for us to cover or questions that you would like us to answer in a future episode, please, to those people that are regular listeners, please send us questions. We have gotten so far just one question from a listener. The rest I have found in various forums. So please do let us know what things would you like us to cover. We try to pick things that we think are interesting, but we would love to hear from you. So reach out to us through our Twitter account at value_ability, or you can submit a topic or question at value-ability.com under the Contact Us tab. Also, you can reach out to us on Facebook, search at valueability, all one word, on Facebook. As always, the mantra of podcasters across time and space: like, review, subscribe, and share. And once again, right now, sharing is the best thing you can do to help us out. Next week, episode 14, Dealing with Debt. We are going to talk about debt, how to manage debt, how to get out of debt, and some strategies for figuring out ways to help people with debt, or if you're working with debt. Even though I've been a financial services employee for my entire career, I had a section of time where I was tremendously in debt right in the middle of my career, and so I'll share that with you, and also how I got out of that, but also I've helped a number of people get out of debt over my career. So yeah, really interesting topic for next week. What questions do our listeners have about dealing with debt? Before next week's episode, reach out to us and let us know what you would like us to cover in that episode. As always, thank you for listening, and please join us next week. Until then, remember that financial success comes from building a plan on the foundation of your values, and building your ability will help you get there. This is a podcast collaboration, not a peer-reviewed journal or a sponsored publication. We make no representations as to accuracy, completeness, correctness, suitability, or validity of any information in this podcast, and will not be liable for any errors, omissions, or delays in this information, or any losses, injuries, or damages arising from its display or use. All information is provided on an as-is basis. It is the listener's responsibility to verify their own facts. You should be aware of the real risk of loss in following any strategy or investment discussed on this podcast. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this podcast may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this podcast. Before acting on information on this podcast, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor. The views and opinions expressed on this podcast are those of the authors and do not necessarily reflect the official policy or position of any other agency, organization, employer, or company. Assumptions are not reflective of the position of any entity other than the authors, and since we are critically thinking human beings, these views are always subject to change, revision, and rethinking at any time. Please do not hold us to them in perpetuity.